everyone, and thank you for joining us today. My name is Fiona Raistrick. I'm one of the partners in Financial Services Advisory here at BDO. I'm joined today by Declan Biddulph and also by Tiana Raviranjan, apologies. So yes, thank you for very much for coming. The first thing that I'd like to say is that from everyone at BDO, we hope that you are all well, your teams, your families and loved ones are safe and well. I just wanted to cover a few housekeeping points. So today's webinar, as you may already have noticed, is being recorded and we'll circulate the slides and recording in a few days' time. Your lines are automatically muted throughout the webinar, so you don't have to worry about dogs barking in the background or children running in the door. Do submit any questions that you have through the Q&A function on the screen. So obviously today we're going to be covering predominantly financial crime risk within the payment sector. So hopefully that was the session you were turning up to today. We'll be covering the key money laundering, terrorist financing and sanction risks present within EMIs and payment institutions, the expectations of a strong and effective AML framework, and some of the key gaps and inconsistencies that we've been seeing in the EMI and payment AML frameworks. In addition, we have also added on a very brief slot at the end that Tiana is going to support with, which we're just actually looking at some of the FCA's current expectations around safeguarding, another actually key primary area for the payments industry. So we thought we'd just tag that onto the end to give you a little bit more context and information about what we're seeing from them at the moment. So we shall crack on with the event. I'm just trying to get my slides all ready to go. So one of the things that we were keen to cover today is not going over the regulatory environment for the payments institutions. You're all in that space, therefore you hopefully all know what that is. What we wanted to make sure that we were clear on was actually what are the expectations, where do the regulations feed into the regulators' expectations, and then how do they look, what do they look like in practice? So obviously, you know, you're aware that e-money institutions, payment institutions are regulated by the FCA, and they're required to comply with POCA, with the Terrorism Act, with money laundering, terrorist financing, transfer of funds regulations, etc. But what we've seen over the past 12 months is a really big increase in the regulatory attention from the FCA in relation to EMIs and payment institutions, specifically in their business plan for 21-22. They raised the concern that this industry is obviously rapidly growing and specifically highlighting the payment sector as one of their priority areas for the next 3 years. So it kind of came through there. It was obviously going to be an area of priority for them, and that is absolutely dovetailed with what we're seeing in the market. This increased regulatory attention has also prompted a lot of banks to sit up and take pay attention. And what we're seeing is an increase in the requests for annual independent external audits, reviews of adequacy and effectiveness of AML controls, that sort of thing, coming from the banks onto the payment institutions so that they get comfortable with the frameworks that surround it. Therefore, really important that you get this right, hence why we're covering this session today. Before we move on, I just wanted to also touch on what we are seeing in relation to the push from the regulator. It's not just those regulatory visits, it's not just the request for data, the desk-based reviews, etc. from the regulator, which I'm sure you're all experiencing. What it also ends up becoming is a really big push on things like skilled person reviews, and where they are identifying weaknesses, they are taking very quick action and they are pushing firms into voluntary variations of permissions, VRECs, and also restrictions over activity if they don't feel comfortable that the frameworks, especially around AML, are robust enough. The other final piece before I hand over to Declan is what we are seeing and what we have historically seen in other sectors is what you find is that some of that action accumulates during the year, and we find that in Q1 of any year is the time when they bring out quite a lot of skilled person reviews, quite a lot of regulatory interventions. And so with this timing of this event is actually quite well planned to give you a heads up that the FCA is all over this. They really, really want to get this right within the sector. They've done similar exercises in other areas, and we see this following a very similar pattern. So I can easily expect quite a lot of activity in the new year in relation to payments. Declan, over to yourself.
Thanks very much, Fiona. I think to begin, we'll just be moving on from the regulatory environment to discuss what we believe the key money laundering, terrorist financing, sanctions risk we believe specific to the industry. So to begin, it's important to highlight that the services in which EMIs and APIs are able to provide is dependent on the license which you received with the FCA. Although firms are able to provide the services outlined within the table, they are not required to provide all of them, and therefore the money laundering, terrorist financing and sanctions risk can dramatically vary based on the products and services offered, and therefore there is no one-size-fits-all approach to counter the aforementioned risks for APIs and EMIs collectively. For example, the money laundering and terrorist financing risk for an electronic money institution or a payment institution which offers currency exchange and payment transactions in comparison to an EMI or API that offers acquiring services looks very different. It is therefore important that you fully understand the money laundering and terrorist financing risks that your business model poses, and that the requirements of the money laundering regulations are applied as applicable. The rapid evolution of the money and payments institution has established alternative and innovative solutions and services for making payments in comparison with traditional banking products and services. And as the industry continues to establish diverse products and platforms, this provides criminals with more options to control and move funds. Based on our research and the slide that we're showing, we believe the risks on the slide are the key risks that are applicable to the e-money and payments institution. To begin, products without limit on usage or value, which can be loaded onto a product, can provide criminals with increased opportunity to launder large funds and move funds quickly and easily. Add that into comparison with cross-border payments and options to have multi-currency accounts, generally offering more attractive exchange rate and cross-border payments, which generally includes payments to high-risk jurisdictions, can increase the opportunity for money launderers or criminals to exploit the products and services within the industry. For electronic money institutions, Regulation 38 of the Money Laundering Regulations allows less stringent CDD requirements, which can be misinterpreted and therefore lead to firms implementing inadequate CDD and EDD requirements. The exemption may also attract criminals due to the option of acquiring products anonymously. Remaining on the same point, some of the services offered by electronic money institutions and payment institutions mean firms may not have a full understanding of who the end user of the product will be. Furthermore, the business models of both electronic money institutions and payment institutions mean that almost all customers will be funded by non-face-to-face methods, which can increase the possibility of impersonation and fraud. And where weak onboarding controls are in place, this may open up the opportunity for your firm to be involved in laundering money or facilitating terrorist financing. Another point we've picked out is that due to the innovation of the payments and e-money services, the use of technology solutions to manage money laundering and terrorist financing risks has increased over the last couple of years. And if these controls are developed and embedded incorrectly and infrequent monitoring is conducting, this can increase the firm's money laundering risk by onboarding customers who are conducting or looking to implement impersonation fraud or just completely misunderstanding the requirements of the customer. We've also picked out another key risk, which is the services that are offered in this industry often use distribution channels such as agents, distributions, or program managers. This presents further risk to electronic money institutions and payments institutions, as firms are expected to understand the AML systems and controls of these business partners, and failure to do so could result in establishing a relationship with other firms in the industry who have weak AML controls, which therefore increases your risk. So now we have identified some of the risks. We'll now look at some of the key themes identified as areas of improvement for firms from their design and control framework. To begin, and although slightly outdated, the FCA conducted a thematic review into the money laundering and terrorist financing risk and e-money sectors and identified the following areas of poor practice. Business-wide risk assessments are too generic and not tailored to the firm's business model and product offering. Customer risk assessments had not been adequately designed to cover all customer types. Policies and procedures were not aligned with UK requirements. Firms were not assessing the nature and intended purpose of relationships. Inadequate EDD measures were being applied. Inadequate resources and processes to manage the risk of program managers, and there was a narrow scope for AML training. More recently, and although not directed at EMIs and payment institutions, the FCA published a DSCO letter to retail banks outlining weaknesses in firms' AML systems and controls. You may be wondering why we have highlighted a thematic review published over 3 years ago and a letter not directed at electronic money institutions and payment institutions. However, the answer is simple. Many of the weaknesses identified in both FCA publications remain the same despite being years apart and covering different sectors, and we therefore believe the points raised are key areas of weakness for firms in the industry. Here, we run through 5 examples of key areas of improvement and our expectations of what needs to be implemented in these areas. To begin, it is the expectation that firms implement a 3 lines of defence model with clear distribution of responsibilities, where the first line of defence are responsible for risk ownership and the second line of defence for risk oversight and monitoring. Where this is not evident, this not only suggests the first line of defence employees do not own financial crime risks faced by the firm, it also impacts the second line's ability to carry out necessary compliance monitoring. In relation to customer due diligence and ongoing monitoring controls, where firms rely on technology to conduct due diligence, this can lead to a lack of fully understanding and assessing other key elements of a customer relationship. For example, assessing and understanding the nature and purpose of the relationship. In addition, EDD requirements are not always tailored to firms' business models and therefore are not adequate to mitigate the risk posed by high-risk scenarios. Finally, where formal periodic review processes are not implemented, this can result in customer information being outdated, which impacts firms' ability in conducting effective ongoing monitoring. Moving on to risk management, firms need to consider implementing a business-wide risk assessment, which considers all inherent risk factors that a firm faces, and the assessment should include an assessment of the effectiveness of AML systems and controls. This assessment should include both qualitative and quantitative data, and where assessments do not adequately assess the firm's inherent risk and effectively measure controls, this could result in firms establishing high-risk relationships or conducting high-risk transactions or operating outside their business and risk appetite statement. Moving on to transaction monitoring, and similar to weaknesses identified in the DSCO letter, transaction monitoring tools need to be supported by the methodology and assessment behind identifying and embedding appropriate rules and scenarios and thresholds for transaction monitoring alerts, or depending on your business model, the transaction threshold and value which require due diligence measures to be conducted. In addition, rationales to support the discounting of transaction monitoring alerts or approval of transactions should contain enough detail and provide an adequate explanation as to why the activity is not suspicious and why you can move forward with the transaction. Finally, for some products and services offered by electronic money institutions and payment institutions, the inherent risk of money laundering and terrorist financing can be considered lower in comparison to other areas of economic crime. And where this is present, firms must ensure it has adequate AML systems and controls in place. For example, firms who provide acquiring and remittance services may focus on the prevention of fraud rather than the money laundering and terrorist financing risk. And it's the FCA's expectations that although the inherent risk may be lower, you should still have systems and controls in to mitigate the risk of money laundering and terrorist financing. Now, we'll run through our expectations of what a strong AML, CTF and sanctions framework should consist of. And a typical framework would include governance and oversight, risk management, due diligence and ongoing monitoring, transaction monitoring and SARS, PEP and sanction screening, and training. The FCA expects all firms to have a framework which has all of these components, but of course, the level of intensity of that component and the controls that sit within will be based on your inherent risks. We will now provide an overview of what we expect each component to consist of. So, first things first, it's important that firms have in place an effective governance and oversight structure. To begin, it is important that senior management set the tone from the top and ensure that the entire firm fully understands the importance of fostering a strong financial crime compliance culture. In addition, it is important that you develop effective committee structures in order for senior management and the board to receive key information on the performance of the AML framework and to provide approval of the AML program, for example, policies and procedures and your business-wide risk assessment. In order for this process to be effective, it is of paramount importance that committee members are provided informative management information, such as the number of high-risk customers, the number of SARs, and the number of customers who have reached transaction value thresholds, for example. This should enable senior management and the board to form a view on the firm's financial crime risks and issues and matters such as the controls are working effectively. As previously discussed, we also expect to see firms implement the 3 lines of defence model. And although we acknowledge for some, there may be an overlap of responsibilities due to the size of your firm, all efforts must be made to clearly segregate roles and responsibilities. Where you implement a strong 3 lines of defence model, this enables those with second line of defence to independently monitor and test the control framework, which can help identify gaps in your systems and controls and therefore fix them quickly. Next up, risk management, which will look at your risk appetite statement, business-wide risk assessment, and your customer risk assessment. To begin, it is important that your business model is reflected in the risk appetite statement. Many clients we work with, we advise that having quantitative risk appetite metrics is incredibly useful to understand exactly what your board's appetite is, whether you're working in or outside. Such metrics could include number of high-risk relationships, number of PEP relationships, number of payments to high-risk jurisdictions. Regarding your business-wide risk assessment, we expect that this includes a documented methodology and a calculation to identify your overall residual risk rating on the financial crime risk which your business is exposed. To identify this, we advise that you use a mixture of qualitative and quantitative data to assess your inherent risks and conduct an assessment into the effectiveness of your systems and controls to mitigate said risks. Finally, based on your business model, we expect that you have in place a customer transaction risk assessment, which assesses the different types of risk customers and transactions pose. A typical risk assessment will cover the type of customer that you're onboarding, the jurisdictions you're exposed to, the level of activity, whether there's any adverse media or PEP exposure, and the level of value of the transaction. Most importantly, the results of the customer or transaction risk assessment should inform the level of due diligence applied to customers. For electronic money institutions that provide services that fall under Regulation 38 of the Money Laundering Regs, we'd still expect that once the exceptions have been breached, that a risk assessment is conducted and that some levels of due diligence applied. Now, moving on to the key topic of due diligence, and realistically, we could be here talking about the regulatory environment, industry best practice guidelines, and a number of different ways in which you can implement a strong CDD framework until the end of the day. We obviously do not have time to run through all of that. However, I feel it would be important to touch on the key areas that we expect to be part of a strong due diligence framework for all firms. Identification and verification, unless exempt under Regulation 38, you must ensure that you identify your customer's identity, address, and where your business provides services to corporate entities, you must ensure the corporate entity is identified along with the identity and address of key individuals such as beneficial owners, directors, and signatories. Traditionally, this information would be obtained by requesting customers to provide copies of relevant documentation, such as passports, certificate of incorporation, and shareholder registers, for example. However, over the past 2-3 years, and in most part due to the innovation of the e-money and payments industry, many firms now use technological solutions to conduct due diligence, such as using electronic databases to identify customers and corporate entities, digital credentials, and biometrics to identify customers' identity, such as face and voice recognition. Where you have such processes in place, you must ensure that the automated tools are working as expected and routinely test them, and also having adequate manual processes in place where the technology does not work or is not available. Whilst the automated tools are effective in identifying and verifying individual and corporate information, it is important that due diligence processes do not focus entirely on this point. And at a minimum, we would expect the due diligence process to include you to understand the purpose and nature of the relationship, understand the expected activity of the relationship, understand the customer's source of funds, understand the customer's source of wealth, conduct screening for high-risk scenarios such as PEP, adverse media, and sanctions, and you should fully document an assessment of the customer file. Although these are generic factors we expect to form part of a good due diligence process, how these are implemented will depend on your business model. For example, an electronic money institution that provides prepaid debit cards, it would be important to understand the customer's source of funds from the outset. However, for a firm that provides acquiring services, this point is indicative by the services provided by the merchant and the value and volume of which can consistently change. Continuing on the topic of due diligence, the diagram on the screen outlines scenarios in which enhanced due diligence is required under Regulation 33 of the Money Laundering Regs, and therefore it is important for you to have systems and controls in place to identify such scenarios. For the purpose of this webinar, we will focus on the requirements to conduct EDD on unusual or complex transactions and via the appropriate risk assessment to have enhanced due diligence conducted on them. The money laundering regulations state EDD must include examining the background and purpose of the relationship and/or the transaction, seeking additional independent reliable sources to verify information, and taking further steps to understand the ownership of corporate structures and the financial situation of your customer. Therefore, as part of the enhanced due diligence process, we have identified the following areas of examples of good practice. Firstly, to verify the customer's corporate entities and UBO's source of funds and wealth. For corporate entities, it may be a good idea to request enhanced KYC for directors and reduce the UBO threshold below 25% to fully understand who the true owner of the corporate entity is. You must also ensure that relationships are approved and signed off by senior management, and this should be documented with a clear rationale as to why the relationship can be established or the transaction processed. Like customer due diligence, the way in which enhanced due diligence is applied is dependent on your business model. Using the example on the previous slide, it would be appropriate for an electronic money institution who provide prepaid debit cards to obtain and verify the source of funds and wealth documents at the point of onboarding for a high-risk customer or at the point of a high-risk transaction. However, for an acquiring merchant, enhanced due diligence may include requesting projected turnover and the corporate entity's audited accounts. You may be wondering why correspondent banking has been included on the slide, as it isn't necessarily applicable to electronic money institutions and payment institutions. However, we believe the requirements outlined within Regulation 34 of the Money Laundering Regulations can be applied to those firms that provide services to program managers and offer products such as BIN sponsorship programs. When establishing such relationships, it is important to understand and gather as much information as possible on the nature of the business of the entity you wish to provide BIN sponsorship services to, and its underlying AML systems and controls, all of which are a requirement for correspondent banking under Regulation 34. I will now hand over to Fiona to run through the remaining expectations of a strong framework.
Thank you, Declan. So the next up on the agenda is looking at ongoing monitoring. And what we mean here is to make sure that you have a strong periodic review process to ensure that your due diligence is not just conducted at the initial onboarding stage, but that actually you are looking at that on an ongoing basis on a risk-based approach to ensure you're keeping tabs on the level of risk associated with your customer base and any changes and movement in that risk. What we've shared here is the key pillars of a strong periodic review process, and what we've identified through the reviews that we've been doing to date is that firms in the payment sector have struggled to implement really strong, effective ongoing monitoring approaches. And almost therefore we want to just take this back to basics. Those key pillars are that the initial starting point is to understand the risk base of your customer population and your client population. align that to your business model, and then understand the frequency with which you believe you need to conduct ongoing monitoring. And that will be on a risk-based approach. You will adapt that frequency based on the level of risk associated with those different customers. So potentially, if you have a high-risk customer, you could be looking at them at least on an annual basis. Medium could be every 18 months, low risk every 2 years, for example. And then once you've identified those risk categories and you've understood that frequency, you then need to actually conduct the periodic review process in line with that timetable. So you would need to make sure that all KYC, KYB is updated, requested new information, identified, updated public information for corporate clients, and make sure that is all updated and documented and considered as part of this periodic review. You should also undertake a holistic review of the activity of the customer or client during the previous period to understand and update your knowledge of that customer's expected activity. As Declan has already mentioned, as part of the onboarding on the CDD and EDD process, you do need to understand the nature of business that's expected from that customer and therefore have an expectation which will feed into the topic I'll talk about next, which will be your transaction monitoring. So you need to undertake that review of transactions, and firms do struggle a little bit with understanding how best to do this. How do you get an expectation where there may be quite a lot of variability? Whatever approach you take, you need to make sure that you thoroughly documented it. And I think, again, this is where firms have struggled, is documenting the rationale as to why they've taken a particular approach, why a particular population of transactions is deemed acceptable or in line with expectation, and why does that fit the customer's risk profile. So all of this activity as part of this ongoing monitoring process must be documented so that you can evidence and support the conclusions that you have reached. In addition, on our third pillar, you need to ensure that the screening is updated and refreshed for all parts of the customer or client, including UBOs, including any PEP aspects, sanctions, adverse media, again, which I'll come on to in a moment. And as a result of all of that updated information, you will need to rerun the risk assessment that, again, Declan talked about, that customer risk assessment, to understand, has that customer's overarching risk position changed from when you last did a periodic review or when you previously onboarded them. So it's exceptionally important that there's a really strong process around ongoing monitoring, because that information can very easily get out of date, and therefore you do need to make sure that that is updated on an ongoing basis. Just one interesting point on from a payments perspective specifically, if you're looking, your approach to a periodic review must be tailored obviously to your specific business model. And what we do also find within the payments sector is that some firms will feel that actually program managers or where you're providing bin sponsorship doesn't have the same expectation for conducting periodic reviews, and actually that's not the case. There still needs to be an assessment of, for example, the third parties, their AML systems and controls. Are they still as robust as they were when you brought them on within the business, etc. So it's adapting what you need to consider, stepping back and thinking about the underlying risk, but then adapting that to the business model that you have. The next area is on transaction monitoring and SARS. Again, a very key area from the regulator, an area that we have seen firms dabble in some ways. They will put in some form of transaction monitoring approach. They will have a SAR approach and a policy, but actually still lots and lots of learnings to be taken from the feedback that we've seen, and lots of enhancements that firms could make to that. The key aspects of a really strong transaction monitoring system is that it's fit for purpose and adapted to your own business model. So there's not a one size fits all. It's very much that you need to consider what is right and appropriate for yourself. It doesn't have to be automated, it can be manual, but obviously if you have significant volumes of transactions, manual may be inappropriate, very costly, time consuming, and hard to manage with manual resourcing. Equally, if you're taking an automated model, you need to make sure that that is tailored and sufficiently adapted to what you need as a business. When you're thinking about the design of your transaction monitoring system, you need to make sure that you've considered and you can conduct an assessment of the business, of the types of transactions that are coming through your business, to make sure that you can get that appropriate calibration, you can understand those thresholds, You can make sure that the right information is being fed into that process, that system or that manual process. So there's some real deep thinking needs to be done in the design. You've already got a transaction monitoring framework in place. One thing you should be doing on a regular basis, and again, at least probably annually, is reconsidering whether that transaction monitoring system, those parameters, those thresholds, those scenarios are still relevant to the business as at now, and also future-proofing your transaction monitoring system if you're coming into an increased period of growth, a change in business model, new business lines, new customer types, etc. So it's really sensible thinking needs to be done and fully documented as to the rationale as to why you achieved that transaction monitoring approach. And again, something firms often fall down on is they might have got a really great transaction monitoring approach, but there's no documentation around it, and especially if it's an automated system that they've bought from outside that actually has been provided to them and tailored for them, but there's limited evidence and documentation as to how they reach that final position. Operationally, you do need to think about, as I say, the tailoring of the rationales, the approach to how you're actually going to then, once you've got those alerts coming out of the system or out of the manual process, how are you going to handle them? How are you going to actually deal with what comes out of that transaction monitoring arrangement? What resourcing does that need? How does that feed back into your peer review process? How does that feed back into your customer activity? What processes do you need to have in place if alerts get raised that then get escalated? Does that lead to closure of clients? Does that lead to putting stops or blocks on activity? Those sorts of things. One of the really important things I think firms sometimes miss is that some of the evidence coming from your CDD onboarding and peer review process is great in terms of feeding into the rationales around those alerts. So it's taking the underlying evidence of what your expectations are around the customer, around where the monies and funds actually come from for some of those higher risk transactions, and joining the dots together when you're assessing the rationales to why a transaction has been flagged. So again, there's got to be really clear documentation around why why that transaction has been raised, and linking it back to the underlying evidence that you already have on those customers. The other area I wanted to cover here, obviously, it was in relation to SARs. So the easiest and most simple way that a lot of firms will cover their SAR obligations is by having some form of internal SAR form. The key thing with that is that it must be available to all staff. Anyone who's dealing with customer information, customer activity, client data, etc., must be able to access that form and must be able to feel free to be able to fill that in, send that in without any sort of problems being raised and problematic questions being asked. They've got to be able to feel free to be able to do that. So there therefore needs to be training or placeholders so that people know where it is and it actually exists. Once that report's been conducted and completed by the frontline individual or whoever it is within the business, it obviously needs to be investigated by someone sufficiently responsible in that area. And whether that's someone within a financial crime team, whether that's purely the MLRO, whoever that might be, obviously there needs to be a thorough investigation of the suspicions that have been raised and evidence gathered and documented to reach an internal decision on what you're going to do with that SAR. Is that SAR going to stop there? And actually there isn't sufficient evidence to take that recording outside of the firm. Is it actually that there's more information that's needed? And now obviously if you are doing that, you need to make sure that you're not tipping off your client, your customer, and that you're doing this in a way that means you can gather the information but without raising any concerns or suspicions on the customer's part. Obviously, if you identify that actually there's sufficient suspicion that which should be reported to the NCA, then most likely the MLRO will have again a process for formalising that as an external reported SAR and submitting that where necessary. And the key with all of this and where firms will fall down is that they need to make sure there is sufficient audit trail for all of that activity, whether it be internal or external, or any ongoing communications with the NCA that may be needed if, for example, the NCA raises concerns and wants you to block an account or stop a transaction, for example. So lots to be done, and the main messaging on these areas is around documentation and evidence to support the rationale for all those decisions. The next area was just briefly looking at the types of screening that firms will need to do, and hopefully you've already got all this type of screening in, but I just wanted to raise some of the points that we've seen around where firms not struggle, because I think actually a lot of firms have acquired some form of service to help enable them to conduct that screening, but where there may be questions that need to be raised, challenges that need to be made to make sure that they're getting the right outcome. So obviously the three key areas of screening you can see are on the screen: sanction screening, PEP screening, and adverse media screening. So obviously this should be conducted on all customers. This should be conducted on obviously payments should be screened, for example, for sanctions. Some of the challenges that I think firms struggle with are in relation to making sure that things are updated, so that your actual lists, the underlying lists, are updated, are appropriate, especially if they've developed something in-house or they're doing it in a more manual approach, making sure that the lists that they are using and the details that they're using are sufficiently comprehensive and sufficiently robust and up to date. So do make sure that you're keeping those up to date. When you're looking at using tools, you need to make sure that you've considered, again, similar to the transaction monitoring, that the thresholds being used for that screening, the fuzzy logic of name matches, etc., the data feeds being used are all actually right, correct, up to date, and relevant to the business. And that you can justify. So one thing we see with things like some of the fuzzy logic aspects is there'll be a percentage, a number. Firms won't be able to articulate and understand why it's that particular level of fuzzy logic. And then when they get asked by the regulator, they'll struggle to articulate that. So if you're buying something off the shelf, make sure you're understanding, well, how is that applicable to me? Why is that level appropriate? What have I done to test that, etc. And then finally on this areas was just considering how, once you do get alerts coming through, your screening, your adverse media screening, etc., how do you actually escalate those? How do you discount them? The biggest piece of feedback I think I ever see with any type of firm, but more recently in the payment sector, is that the discounting of alerts is not done well. It's not necessarily purely the discounting, it's the documentation surrounding that discounting isn't sufficient. It'll be quite a dismissive comment. It'll be, well, this isn't relevant, or this isn't this person, or you need really strong evidence and justification as to why an alert can be discounted, and you therefore need to give appropriate training to your teams to make sure that they understand what expectations there are. That leads me very nicely onto training, which I'll just quickly run through before handing over to Tiana. Obviously, I'm sure you will all train your staff in some level on AML, financial crime controls. But what we find is that it can often be quite generic and not tailored to the individual businesses. And also there's limited evidence supporting the reasons why training was given to particular people and how well they did, etc. So here we've just got a little wheel that shows the core areas. Make sure you've conducted and documented a training needs assessment. So you've gone through your staff population and you've understood where training is needed. There's a blanket set of training that everyone should do. There will be more tailored internal training that some people should be doing, especially those in some of the core frontline roles and some of the second line roles. You should have therefore a training plan on the back of that to show how you're evidencing your training throughout the year. Training should be at least annual and more regularly for those in those key positions. The reason we've added in this tailored in-house training is don't just rely on your e-learning modules. They will not be sufficiently in depth to get you across the line in terms of those regulatory expectations. So there needs to be some form of in-house training, whether you get firms to come in like ourselves, or whether you use your MLRO or an internal training team, for example, or whoever it might be, to do tailored specific training with specific examples for those particular populations. And as a result of that, you should also have evidence that the training has been done. records of those e-learning modules, which is easy, but also assessments, results, tests, other things that can demonstrate that that training has been done and was effective. On that whistle-stop tour through the expectations of the FCA in relation to a good, solid regulatory framework around AML, I will quickly hand over to Tiana for some comments on safeguarding, another very key important area for the sector.
Thanks, Fiona. Morning all. I just wanted to use the next 10 or so minutes to briefly discuss some safeguarding. So I initially wanted to touch on the background to safeguarding, which highlights the journey of how we've got to where we are today and the requirements for an audit, as well as what this actually means, looks like, and how we can help. So just echoing what has been mentioned by Fiona and Declan regarding an increase in regulatory attention, we've seen increased focus by the FCA in respect of safeguarding over the last couple of years, and the need to better protect customers and reduce the risk of financial loss. So the diagram on the slide shows how this has evolved over time, and particularly over the last few years. And I think it's fair to say the FCA has continued to review how well firms are meeting and continue to meet the safeguarding requirements in practice. Quite hot off the press is the more recent policy statement published last week, so on the 29th of November, which was published on the back of earlier consultation and aims to consolidate expectations and provide further clarity for the industry. Also produced was version 5 of the approach document, and we're currently in the process of doing a compare and contrast on this relative to the prior version. On the next slide, so on the next slide, we have the high-level summaries of the various guidance documents. And I wanted to particularly draw your attention to that most recent guidance, so PS 2119 on the bottom right of the screen. So in respect of safeguarding, this focused on and provided further clarity on a few bullet points. So firstly, the type of assurance and the requirements of an annual audit. So the FCA clarified that it expects a reasonable assurance opinion to be provided, whilst not mandating a particular audit standard. In addition, further clarity on the requirements for an audit, in that if an e-money or payments service firm is required to arrange an annual audit of their annual accounts, there's also that expectation to arrange a safeguarding audit. However, it is worth noting that even if you're not required to have a safeguarding audit, the FCA still expects those firms to have controls and processes in place to ensure that funds are safeguarded. In addition, the FCA also provided further examples on what would constitute a material change to business models, and therefore when an additional safeguarding audit may be required, as well as also further examples on when they would expect to be notified of a change of an inability to comply with safeguarding requirements. There was also further clarification on the start and end points of the safeguarding obligations, as well as the use of acknowledgement letters and the insurance or comparable guarantee method. So slightly expanding on that first point in respect of the expectations of an audit. So the PSR and the EMRs initially set the scene here in respect of the need to undertake audits, so in respect of the provision of payment services. And this was further expanded by the approach document, which outlined the requirements for a firm's auditors to tell the FCA if it has become aware in its capacity as an auditor of a breach of any requirements imposed by the regulations that is of material significance. So in terms of the resultant opinion, the expectation is this is addressed directly to the firm and attests to whether the firm has maintained organisational arrangements adequate to enable it to meet the FCA's expectations of its compliance with the safeguarding provisions of the EMRs, the PSRs as set out in the approach document, and that this was for both throughout the period and as at the period end date. In terms of what this then looks like, so our reviews are conducted under ISO 3000, which are generally applied for audits of internal controls and compliance with laws and regulations. So in this circumstance, being the compliance with the safeguarding requirements of the EMRs, the PSRs as set out in the approach document. The FCA did clarify, as mentioned, that they are not mandating the use of a specific audit standard. However, acknowledge that in the longer term, there may be scope to develop a bespoke audit standard for the sector. And although no specific audit framework was noted, there is an expectation that a reasonable assurance of opinion would be provided. Within the opinion itself, there are three types of conclusions permissible. So firstly, a positive conclusion whereby, in our opinion, the company has maintained organisational arrangements adequate to enable it to meet the FCA's expectations of its compliance with the safeguarding requirements. The second opinion is an except for opinion, whereby, in our opinion, except for the breaches listed in the breaches schedule, the company has maintained organisational arrangements. And this is the most common opinion that we're seeing, as the expectation is that firms will have breaches. The third and final opinion is the qualified opinion, whereby, in our opinion, because of the significance of the items described, the company did not maintain organisational arrangements. I think in those last two opinion pieces, I mentioned the breaches schedule. So this is appended to the opinion and essentially includes all breaches identified by both the firm and by ourselves, and as well as linking to the the appropriate regulation or the appropriate guidance documents. In addition to the opinion, we also provide a management letter, which should be read in conjunction with the report on the breaches. And in addition to kind of being a longer form report, which provides a bit more detail on the scope, the approach, we also use this to bring out wider observations, points of best practice that we're seeing throughout the market. So through comparison to other similar sized firms, as well as providing recommended actions to help implement these and remediate any gaps. The final document which we request from firms is a representation letter. So essentially just attesting to the completeness and accuracy of the information obtained during the audit. So the last thing I quickly just wanted to touch on before finishing and handing back to Fiona was on what our audit scope looks like and what it covers. So under ISO 3000, there is no detailed guidance on what should be included for the performance of an engagement. So implying that it's up to us as auditors to use professional judgment to define the scope, the amount of controls tested and the testing method. So as a result, we have developed a standard audit scope derived from the Chapter 10 requirements and focusing on 5 main areas. So firstly, the governance and oversight. So essentially this covers the organisational arrangements in place, including ensuring that there is a documented rationale and approach, so in the form of policies, procedures, as well as also ensuring that appropriate oversight exists. So an appropriate individual and committee has responsibility for ensuring compliance with safeguarding requirements, as well as that appropriate MI is being shared and discussed at these forums. We also review the breach process, so including the identification, the reporting, the escalation and remediation of breaches, as well as considering training provided to both operational teams as well as relevant board and committee training. The second scope area is safeguarded funds. So looking at the identification of relevant funds and whether appropriate consideration has been given to the start and end points of the safeguarding obligation, as well as, I guess, more generally just looking at the flow of funds. The third area is the safeguarding method. So as the name suggests, looking at the methods of safeguarding used, be that the segregation method, the insurance method, or use of a comparable guarantee. Also within this, we also look at the safeguarding accounts and the maintenance of these. So ensuring that bank letters exist and they have the appropriate designation, as well as that appropriate kind of ongoing due diligence has occurred in appointing and reviewing these credit institutions. The fourth area is the reconciliation. So looking at the timeliness and process for safeguarding reconciliations, as well as looking to ensure that the subsequent remittance of funds has occurred on a timely basis. Also within this area is a consideration of the ITGC, so the IT general controls, and looking at the systems specifically involved in safeguarding and how they kind of all interlink, how the funds and information flows between systems to ensure the accuracy of these. The final area is the impact of insolvency. So this includes an assessment of the business continuity and resilience plans in place in respect of safeguarding. So looking at the wind down plans in place. Just going to hand over now back to Fiona for the Q&A and wrap up. Thank you.
Thank you very much. So if anyone did have any questions, do please put them into the Q&A function. We've had a couple so far. So one of them was very specific. We've got a firm who is going through moving from a payments institution to e-money permissions, and actually kind of wanted to understand what the impact would be from an AML perspective. I think one of the key things to reflect on there is the firm will need to do obviously an updated business-wide risk assessment to understand the implications of the change in business model. And that would be the same with any change, whether it's actually something that requires regulatory permission changes or just something within the existing remit of your regulatory environment. And that business-wide risk assessment is critical to make sure you've considered all of those business lines, you've considered all of the angles that could affect the business in relation to financial crime risk. This doesn't also just have to be in relation to AML, it can obviously cover wider risks as well, fraud, bribery, corruption, etc. But the key thing will be to make sure that you've updated that risk assessment, you've reflected on what that then means for the existing control frameworks that you have in place. And if you identify any gaps or any areas of high risk that aren't mitigated by your existing control framework, you will need to update that and obviously make sure that gets cascaded into the rest of your framework. Just on that as well, one of the things I wanted to flag was one of the areas we haven't mentioned in today's session is around policies and procedures. It's something everyone will have. They'll have an AML manual, they'll have a set of procedures, etc. And expected. We didn't want to really cover it in any detail today because we imagined firms would have one in place already or have something in place already. One word to reflect on though is what we do find is where firms have a risk assessment, they have a set of processes. So they'll have forms, whether it's take-on forms, whether it's online system driven information, etc. They'll have individual procedure documents potentially. What you need to make sure is that they all talk to each other, they are all consistent and collaborative, and what you're not getting is either gaps in your documented framework, or that you've got inconsistencies in what you've got in a policy which may be more standardized and driven by text from regulation, and the practical procedures and other aspects that you've got within your framework. It's very easy to see, we do see it very often where firms have tried, but actually they end up with inconsistencies because they've not looked at that collective suite of documents across the board in one respect. The other question that we had was, what was our view on machine learning generally? And obviously a very big question, and not something we're probably going to touch on too much, as we've not got very much time left today. But I think what we are seeing is an increase in the use of technology to make processes and make aspects of the financial crime framework more efficient. The FCA is very conscious of things like machine learning and AI coming into that environment. I think if you are looking into approaching that as part of your framework, make sure you understand what it's going to do and how it's going to help, and don't just get the third party to come in and put in an infrastructure that actually doesn't really work with what you need. But also being aware that it is not a catch-all solution. So the question actually referred to whether the FCA would indemnify if anything went wrong with it, and it made wrong choices and wrong conclusions. Obviously, they're not going to do that. Ultimately, there's going to be accountability from senior management and MRO, etc., for things that go wrong. But if you can demonstrate that reasonable steps were taken in understanding why that technology or any other parts of your framework are implemented, how you're monitoring that and reviewing that on an ongoing basis to make sure that it maintains fit for purpose and that its conclusions and outputs are working well, then great. You've got yourself covered. You've made sure you've taken the right steps to get to the right position. Don't see, I'm just going to double check if we've got any other questions. It doesn't look like we've had any more questions today. So all I wanted to just wrap up with is say thank you very much for attending our webinar today. As mentioned at the start, we will obviously be circulating the recording and a copy of the slides over the coming days. If you do have any further questions, or you are keen to have a discussion on any of the aspects that we've covered today, whether it's on the AML side, whether it's on the safeguarding side as well, which may be helpful and relevant to some of you, then obviously do contact. We'd be very happy to discuss. If a skilled person review or a regulator visit or a desk-based review pops into your inbox over the coming days and weeks, again, do reach out. We're very happy to give some guidance on how to approach the interactions with the regulator. Obviously, we do act as skilled person in those events, but equally we also support firms who may need to go through remediation following feedback from the regulator or a skilled person review, etc. So thank you very much again. Thank you to all the team who presented for us today, and just have a good rest of your day. Thank you so much.